Stephen Rutenberg.
It's great to be here, and I consider this next discussion a bit of a continuation of the break because I'm not talking about ICOs and not talking about regulations at all. So we can take a little bit of the break from the funding for a little bit and talk about the syndicated loan market as a potential use case for blockchain, and through that we can see some of both the advantages as well as the struggles that the market has had over the last 2 years. So just first, a bit of what is the syndicated loan market, which is, we're not talking now about making loans on platforms or new loans. This is an existing market of approximately $1 trillion where it still settles manually. I mean, actually, even with faxes. And loans often take T+15 to settle. Payment discrepancies are common. Administrative agents in closing loans often will end the last week of the quarter, the last 2 weeks of the quarter. So it's this huge market that is, from a settlement perspective, highly inefficient. It's as if we said that like there were people like using horses and buggies in like Orange County or flip phones or something like that. So I mean, there's this whole market out there that's running very different than the T+3 that we're trying to have in terms of settlement or even instantaneous. So when blockchain came out a couple of years ago, and we'll talk a bit about how blockchain fits into this, it's like, wow, this is like, let's hit the syndicated loan market first, similar to in countries like Africa never really had landlines and went straight to cell phones. So it's like, let's go straight in the syndicated loan market and let's put the whole thing on a blockchain, which is really what you were hearing about 2 years ago is what's going to bring the syndicated loan market up to the 21st century. And you'd go to like a conference like this, and you still have it, is half the people are trying to save the world and half the people are trying to fire their middle office. And this is going to save those inefficiencies. And there still are opportunities there, and additionally, in addition to the slowness of it, the regulators are worried that in the next time you have a bad economy, I mean, if you have a syndicated loan, you can sell it tomorrow. But you won't actually get your money even between 2 weeks to a month. And if people really need money, right, that could become a real issue, which is one of the reasons why, even though the loan market has not been a security, it's had scrutiny by the Fed. So the Fed would like if this moved to a faster settlement. And if you think about it, as somebody from this session did at New York Law School last summer, it's like if you have $1 trillion and you have 2 weeks of settlement and people are holding cash for 2 weeks, that's a lot of money that's being held up in the economy. So how could blockchain help? And just by way of a bit of a background of where this all came from, I think most people here are familiar with the background of Bitcoin and blockchain and how this whole fits together. The core of it is really two things. One is solving the double spend problem. Until Bitcoin came around for the last at least 500 years, if you wanted to transfer something to somebody, you needed an intermediary. Bitcoin comes around with this protocol that, like, no, I can use the crowd. I don't need, in a highly simplified way, I don't need to use, I could either use the whole public or I could use a section of the public, and therefore, who needs the intermediaries that are slowing down potentially this loan process? Let me just, I can do it direct. And with this, we'll basically refer to distributed ledger and Bitcoin and blockchain are really the same thing. And though you can theoretically have one without a distributed ledger that's not on a blockchain, but we're not going to think about that now. And then once you have a distributed ledger, there are many types of it, and which will be one of the things that actually slows it down. You can have it, the Bitcoin blockchain is this public blockchain for basically anybody could be a center on it, as is Ethereum. But what's being discussed is actually an idea of having a small group of banks being the trusted node. So the idea that people started to think about is, instead of relying on an administrative agent or someone else to transfer our loan, let's just have a network of trusted parties. We'll share all the information, and therefore instantaneously settlement of it. And the newest thing that we're seeing is people talking about first having your data off the blockchain, which means it really isn't, to me, a blockchain loan, or The newest systems are blockchain inspired, meaning it's not on a blockchain at all, but it uses some sort of decentralized or computerized system. But what makes it particularly interesting, the distributed ledger technology with the loan market, is when you combine blockchain technology with something called a smart contract. And smart contracts have been something that people have been thinking about in this space for many years. No connection really to distributed ledger. But when we're talking about a smart contract here, what we mean is basically an if-then. If I don't pay my mortgage, I lose my house automatically. You know, the collateral could be on, or suddenly it automatically executes. So if you combine the idea of having something on a blockchain where it's decentralized, plus you combine that with a smart contract, you can, in theory, put it all together. And you could have a loan that just almost runs itself. And the idea would be, and there are other people who have slides who have this much prettier. This is not the prettiest version of this slide, but in theory, you can start with having all the data, all the data there. The credit agreement, as somebody pointed out this morning, a blockchain in this situation could just be a ledger. It's really just an electronic version of a ledger. But if you put the data there and then you combine that with some sort of smart contract, you can actually have the whole thing running automatically. You can have the interest payments, which is probably the biggest problem with the loans, get paid automatically. And then on the more scary side, when you don't pay the loan, the collateral can automatically transfer because the blocks can just transfer from one to the other, and you're done. And then anybody can do any loan, and it'll have instantaneous settlement, instantaneous negotiation, and then instantaneous foreclosure. However, that's not really what's happened. And we haven't really seen that happen yet in the loan market. And in addition to this, there's so many reasons here why a blockchain type technology could be helpful for the loan market. There's the loan documents, there's electronic signatures, there's potential of putting the KYC and AML there. And if you put it all together, you end up with this fully decentralized loan product, which is really taking the loan product from the 18th century to the 21st century. The problem is that you really haven't seen this happen yet. And I think there's a lot of lessons for where the blockchain is going in terms of existing markets from what we've seen with the loan market so far. One problem is that the loan market is fairly trusted already. People in the loan market know each other, trust each other. One of the reasons, and another side point, even though we're not talking about regulation here, why loans are not considered securities is because there's no retail in the loan market. The loan market are basically accredited investors, large funds trading between each other. So the question is, do you really need this external source when you're already trusting each other? Yes, your settlement is inefficient. The other question is, do you really want efficiency in this market? I mean, people make a better spread in the loan market than they do over bonds because it's not that efficient. And someone at a different panel, another conference, was talking about an idea of all this great efficiency. I said, I have an even better business idea. I'm going to go into movies after 5 minutes and give away the end. I mean, there's reasons we don't want efficiency complete in all of our markets. And then additionally, at the end, why do we really want our smart contracts to govern our loans? If it's a corporate loan to Toys R Us, then maybe we don't care. But when you start talking about this being a commercial loan or somebody's mortgage, do you really not want that to be done by a human? So where have we ended up with the loan market so far? After going from 2 years ago, an idea of that chart of having the entire thing on the loan market, we're down to right now 2 products that I know of trying to put loans on a blockchain. Both of them are deep in the payment area, and both of them keep the administrative agent. So if you're transferring a loan, there's an administrative agent that transfers it. And the idea of a blockchain was supposed to make that go away. That's kind of been put on the side, or a very long-term side, with nobody really working on that now. And the one product is called Synaps, which is done by a consortium of a company, Impro, which was actually just bought by Market, which we'll talk about in a second, and Symbiont, which was behind the Delaware Blockchain Initiative. And their idea is to speed up settlement, but really mostly to work on the payment. So the loans are still going to be your old loan on paper. It's still going to settle right now on paper. It's still going to be transferred on paper. But the back payment will be done through some sort of blockchain component, where I can see a real advantage of that, because the one area people don't trust is they don't want Market, which actually does the settlement of all the loans, to know their position. So there actually is a privacy reason why blockchain would make sense from there. And they're probably the most forward right now, but again, it's a very limited idea of what they're doing, of just a distributed basis to understand what your interest payments are. So it won't even affect settlement. It's really just going to affect post-settlement. The other big product out there is something called Finestra LenderComm, which again is even less than the Synaps product, in which, as you can see from their slide, the agents' banks are still involved, and it's really just on the payment side. So we've gone from the idea of we can take this to intermediaries are bad, the loan market really doesn't work, to, well, maybe it's not so bad as it is. Maybe the settlement isn't that big a problem. This is not necessarily a function that's going to work right now. Let's take a step back and just work on the payment thing, which is really what we're seeing now. And the LSTA, which is the organization that governs the settlement of loans, they've published 3 white papers, which are, I can send it to anyone, even though technically I think it's $2,500 if you're not a member, but where they go through some of the detail of how this, of what they're thinking. And you can even see in terms of their papers how the thought process has moved to, wow, this is really going to revolutionize this market to, let's move it to payment system. And the question with some of these is, does this need a blockchain if it's just payment, or could it be some other sort of computer system? One other area of where actually the LSTA is working on now, which I think is a very important area when you're trying to combine loan agreements and cryptocurrencies, is, let's say you have a loan agreement, and this is something that everyone should be thinking about now. If you're a lender and a company has a covenant that they can't borrow more than X amount of dollars, let's say they do a fiat, let's say they don't do a fiat, let's say they borrow, let's say they do an ICO, let's say it's, whether it's utility token, a security token, suddenly you have a company with a lot more, could be a debt, it could be something on top of you, which, how does that affect any of your collateral reps? Let's say the money goes out, you suddenly, it's a different position in the company. So the LSTA is actually working with someone at MoFo now to propose credit agreement terms to deal with digital assets and credit agreements. And that's something that regardless of whether this affects the underlying credit agreements, we should be thinking about in any of our assets. Because if you're a company issuing shares, if you're a shareholder, you could be wiped out by a somewhat crypto round if it's not clear that way. I think Delaware is thinking about it, the LSTA is thinking about it, but that's one practicality that you should think about even before this happens. And then just a final word on what a lot of people are thinking about, but not really the main topic of discussion here, and where I do think you're going to see a change in loans on a blockchain are the many products out there that are trying to issue a new type of loan, not your syndicated bank loan, not using, just starting from scratch of just issuing a loan on a blockchain. And I think that's where you're going to see it potentially competing with the existing loan market before the existing loan market takes it itself. And in that thing, I really would kind of call it that there's 2 types of ways, if you wanted to put your entire loan on a blockchain, that you can do it. One is, I'll call it the avatar approach, in which you still have your paper credit agreements, you still have everything that you would have had before, but the ledger is a blockchain. It's whether it's some sort of hash function or otherwise, that you put the ledger there, and you can therefore be more easily transferred. That's probably the easier approach. The other approach is to actually put the full loan documents on a blockchain like we were discussing in the beginning, whether it's with a smart contract to actually pay it or still manual on the blockchain. So I think what you're going to see is, before you have the trillion-dollar syndicated loan business, you're going to have certain private lending platforms get set up, and then you can't not mention the idea of having a currency to give you access to a platform, which is what lots of people are doing now. And any questions? And that's just my kind of overview of the loan market. Yes?
Business development companies, BDCs provide these syndicated loans very often, or they provide part of the loan. And very often what they do is that they do debt securitization. So they refund, they refinance the loans which they have given out. In that case, this becomes the loan is gets securitized. So it's not that the loans always stay the way they are and there is one person but at the back and they are securitizing the loans.
Well-
So unless that is offered on the blockchain, would it even work without securitization?
I mean, well, I think those are separate. It's a good point. I think the question is, how does securitization fit into this? The loan market, which is it's not a security under the securities laws, though you could securitize a loan where you basically, when you're securitizing something, it's nothing to do with the word security. It basically means you pool them together and sell notes behind it in a gross oversimplification of what that is. Those notes are securities, partially because they're sold to retail investors and so on. There is an active market in loans. I'd say most loans go into a high percentage of your syndicated loans go into CLOs, which are a form of securities. And there are talk of doing blockchain CLOs, and that's a different model, somewhat more contained, because the loans would still go in a pool. You could have loans that are regular paper fiat loans, and you can then put your interest in those loans on a blockchain, either in one way or another, and then sell some sort of crypto token out of that. And the loan stays the way it was before, and I think there are definitely people working on that and doing securitization. It could be a mortgage, it could be anything. You keep your underlying asset that's real, that's not a token, done in a somewhat old-fashioned way. You kind of connect it to a blockchain, and then you sell digital tokens or digital assets under that. And that could work, and I think that's going to happen before you actually see this kind of cumbersome old school loan market itself get changed.
Excellent. Unfortunately, that is the only question we do have time for, but we encourage you to connect with Stephen after the presentation. Thank you so much, Stephen Rutenberg. Thank you.